If you bought silver at $84 on December 28th, you watched 12% of your money vanish in less than 48 hours. If you panicked and sold at $73, you sold at the exact bottom and then watched it bounce back above 77 while you sat on the sidelines. And if you're watching this right now trying to figure out whether to buy, sell, or hold, you need to understand something before you make your next move. This crash was not random, it was not a bubble popping, and it was not the market correcting itself naturally. What happened on December 29th was a forced liquidation event triggered by a regulatory decision made on a holiday weekend when most institutional traders were on vacation and market liquidity was at its thinnest point of the year. The timing was not a coincidence. And what happened in the 72 hours after that crash, specifically what China announced on January 1st, changes everything about where silver goes from here. The next few minutes could determine whether you position yourself correctly for what analysts at Bank of America are now calling a potential move to 135 or even 309, or whether you get shaken out right before the biggest leg up in 45 years. Let me show you exactly what happened, who benefited, and what the smart money is doing right now. Here's exactly what happened. On December 26, 2025, silver was on an absolute tear. It had just broken through $80 for the first time in history. Social media was flooded with posts calling for $100 by year end. The momentum felt unstoppable. By December 28th, silver hit an intraday all-time high of $84 or 1 per ounce. Then, on that same day, the CME Group, the exchange that controls silver futures trading, released advisory notice 25 amount to 393. This notice announced that initial margin requirements for March 2026 silver futures contracts would increase from $22,000 to $25,000 per contract. That's a 13.6% jump. And this was the second margin hike in less than 14 days. To put that in perspective, at the beginning of 2025, margin requirements were around $8,000 per contract. By late December, they had tripled. Now, here's the critical detail that most people missed. This announcement dropped on Friday, December 26th, the day after Christmas. The exchange knew exactly what would happen when markets opened on Monday. Institutional traders were on holiday. Trading desks were running skeleton crews. Liquidity was already thin because of the holiday week. When that margin call hit, thousands of leveraged traders had two options: post an additional $3,000 per contract immediately or get liquidated. Most of them didn't have the cash sitting ready. So on December 29th, the algorithms took over. Forced sell orders flooded the market all at once. And when thousands of sell orders hit a market with almost no buyers, the price doesn't just drop, it collapses. Silver went from $84 to $80, then $70, then $75. By the time the selling stopped, silver had crashed to $73.72, an 11% wipeout in a single session. Retail traders who bought at the top with leverage were completely wiped out. Stop losses triggered across the board. Margin calls liquidated positions automatically without any human decision being made. And while all of this was happening, while the price was in free fall and panic was spreading across every trading forum and social media platform, someone was buying. Large buy orders were sitting and waiting at $74, $73, at $72, and they got filled. The question is, who placed those orders? And did they know this was coming? To understand why this crash was so violent, you need to understand how leverage works in the futures market. When you trade silver futures, you don't put up the full value of the contract. You put up a fraction called the margin. That margin acts as collateral. So if silver is trading at $80 per ounce and one futures contract controls 5,000 ounces, the full contract value is $400,000. But you only need to post $25,000 in margin to control that position. That means you're trading with 16 to 1 leverage. When prices move in your favor, this feels incredible. A 5% move in silver becomes an 80% gain on your margin. But when prices move against you, that same leverage works in reverse. A 5% drop doesn't just hurt, it wipes out a massive chunk of your account. And here's where it gets brutal. When the CME raised margin requirements from $22,000 to $25,000, every single trader holding a silver futures position suddenly needed to add $3,000 per contract to their account, immediately. If you were holding 10 contracts, you needed $30,000 in fresh cash. If you were holding 50 contracts, you needed $150,000. This hit on a holiday weekend. Banks were closed. Wire transfers were delayed. Most traders couldn't move money fast enough, even if they had it. So the exchange's automated systems did what they're programmed to do. They started liquidating positions. These aren't human decisions. There's no phone call asking if you want to add funds. The algorithm sees that your margin is insufficient, and it sells your position at market price. Whatever price is available. Now imagine thousands of these liquidations happening simultaneously. Every forced sell order hits the order book at the same time. But there aren't enough buyers to absorb them because liquidity is thin, so each sell order pushes the price lower. And each price drop triggers more margin calls on other traders, which triggers more forced selling, which pushes the price even lower. This is called a liquidation cascade. It feeds on itself. The selling creates more selling. And it doesn't stop until either the leveraged positions are flushed out or buyers step in with enough capital to absorb the volume. On December 29th, the cascade ran until silver hit $73.72. That's where the buyers were waiting. Large institutional orders, likely placed days or weeks in advance, were sitting on the order book at those levels. They got filled at prices 12% below where silver was trading just 24 hours earlier. These weren't retail traders panic buying the dip. Retail traders were the ones getting liquidated. These were patient, well-capitalized players who understood exactly how the system works. They knew that when margin requirements spike during a low liquidity window, over-leveraged positions get flushed. They knew the price would overcorrect, and they positioned themselves to buy the forced selling. Was this illegal? No. The CME has full authority to adjust margin requirements whenever they deem it necessary for market stability. Was it predictable? If you've watched silver markets long enough, yes. This exact pattern has played out before, and we'll get into that history later. But first, I need to be clear about something. Nothing I'm sharing in this video is financial advice. I'm not a licensed financial advisor. I'm not telling you to buy silver, sell silver, or hold silver. I'm presenting information and analysis that I think is important for anyone watching this market. Silver is one of the most volatile assets you can trade. The crash you just heard me describe, that 12% drop in a single day, that can happen again. It can happen in either direction. And if you're using leverage, you can lose everything in hours. Whatever decisions you make with your money need to be based on your own research, your own risk tolerance, and your own financial situation. With that said, let me show you what happened next. Because while the paper market was collapsing, something very different was happening in the physical market. While futures traders were getting liquidated and the paper price was crashing to $73, something strange was happening in the physical market. Dealers didn't drop their prices. If you went online on December 29th, trying to buy a Silver Eagle or a 10-ounce bar, you weren't paying $73. You were paying $78, $80, sometimes higher, depending on the dealer and what was in stock. Premiums over spot, which normally run a few dollars, spiked to $8 or more. Some dealers stopped taking orders entirely. Websites crashed from traffic. Inventory sold out within hours. This is the first sign that the crash was a paper market event, not a real supply and demand shift. Think about it. If silver was genuinely crashing because demand had disappeared, you would see the opposite. You would see people lining up to sell their physical metal. Coin shops would be flooded with sellers trying to get out. Dealers would be slashing prices to move inventory. None of that happened. Instead, buyers stepped in. Hard. The same thing was happening in Shanghai. Physical silver on the Shanghai Gold Exchange was trading at a premium of 8 or more above the paper price in London and New York. Chinese buyers weren't panicking. They were accumulating. This price gap between East and West, between physical metal and paper contracts, has a name. Analysts are calling it the Great Divergence. And it tells you something critical about what's really going on. The futures market is where the price gets set. It's where the algorithms trade. It's where leveraged speculators make their bets. And it's where the CME can change the rules overnight with a margin hike. But the physical market is where real metal changes hands. It's where industrial users buy silver because they actually need it for manufacturing. It's where long-term holders accumulate bars and coins that sit in vaults and safes. And during this crash, the physical market didn't blink. Industrial buyers, the companies that use silver in solar panels and electronics and electric vehicles, they saw prices drop to $73 and they started buying immediately. These aren't speculators looking for a quick trade. These are manufacturers securing inventory for production lines that can't stop running. When they see a 12% flash sale on a metal they need and can't substitute, they don't ask questions. They buy everything available. This physical demand is why the price bounced so quickly. Silver didn't stay at $73 for long. Within 48 hours, it was back above 70 cents an hour. Within a week, it was pushing toward $80 again. The paper market can be manipulated through margin hikes and forced liquidations. The physical market is harder to control because it is based on actual metal moving from sellers to buyers. And right now, there's not enough metal to go around. The deficit is real. The industrial demand is real. And what China just announced on January 1st is about to make the supply situation much worse. On January 1st, 2026, while most of the Western world was recovering from New Year's Eve, China's Ministry of Commerce activated a new export licensing regime for silver. This is not a total ban, but what it does is almost as severe. Starting January 1st, any company that wants to export refined silver out of China must first be approved as a state-authorized trading enterprise. Then they must obtain an individual export license for each shipment. Without both approvals, no silver leaves the country. And here's the part that matters. To qualify for approval, a company must have produced at least 80 tons of silver in 2024. They must hold ISO 9000 and ISO 14000 certifications, and they must meet a list of compliance requirements that effectively block small and mid-sized refiners from exporting anything. This wipes out hundreds of smaller exporters who have been supplying global markets for years. Now consider what China controls. China refines between 60% and 70% of the world's silver supply. They're the choke point. Raw silver ore gets mined in Mexico, Peru, Australia, and other countries, then shipped to China for refining. Chinese refineries process it into the industrial-grade silver that manufacturers need. And then that refined silver gets exported to the rest of the world. That pipeline just got a valve installed on it, and Beijing controls the valve. This is not a new playbook. China did the exact same thing with rare earth elements over the past decade. They used export quotas and licensing requirements to restrict supply, prioritize domestic industries, and gain leverage in trade negotiations. Now they're applying that strategy to silver. The timing is not accidental. China is in the middle of the largest solar panel build-out in history. They're manufacturing more electric vehicles than any other country. Their factories need silver for electronics, for photovoltaic cells, for batteries, for AI server infrastructure. Why would they let that silver leave the country when they need it themselves? Elon Musk commented publicly on this within days of the announcement. He responded to a post about the restrictions on X and wrote, "This is not good. Silver is needed in many industrial processes." He's right, and he would know. Tesla uses silver in every vehicle they produce. Solar panels, which Tesla also manufactures, use silver paste for electrical conductivity. If Chinese silver becomes harder to source, his supply chain has a problem. But here's what makes this situation different from rare earths. Rare earth supply disruptions show up slowly. They create delays in production, gradual price increases, and supply chain bottlenecks that take months to materialize. Silver is a financialized commodity. It trades on global exchanges with real-time pricing. When supply gets restricted, the market reacts immediately through price spikes and volatility. We're already seeing the early signs of this. The Shanghai premium over London and New York prices has been running 8 or higher since the restrictions took effect. That gap represents the real cost of getting physical silver out of China. If the licensing regime tightens further, that premium will widen. Analysts are projecting that if Chinese exports drop by 50%, the global market could face an annual deficit exceeding 5,000 metric tons. That's on top of the deficit that already exists. The supply squeeze that started as a structural problem just became a policy-driven crisis. And the supply deficit didn't start in December. It's been building for years. Silver has been in a structural supply deficit for 5 consecutive years. Well, that means global demand has exceeded global mine supply every single year since 2020. In 2025 alone, the deficit was estimated at over 300 million ounces. To put that number in context, total global silver mine production runs around 800 million ounces per year. So the market consumed roughly 40% more silver than mines produced. Where does the extra silver come from? Existing inventories. Recycled silver. Stockpiles that have been building up over decades. Those stockpiles are getting drained. COMEX registered silver inventories, the metal that's actually available for delivery against futures contracts, have been declining steadily. London Bullion Market Association vaults have seen similar drawdowns. The physical metal that backs the paper trading system is disappearing, and the demand side is not slowing down. It's accelerating. Start with solar. Silver is a critical component in photovoltaic cells. It's used in the conductive paste that allows solar panels to convert sunlight into electricity. There is currently no commercially viable substitute that matches silver's conductivity. Global solar installations hit record levels in 2025. China alone installed more solar capacity last year than the entire world did 5 years ago. India is scaling up rapidly. The United States and Europe are pouring billions into renewable energy infrastructure. Every single one of those solar panels needs silver. The Silver Institute estimates that solar demand consumed over 200 million ounces in 2025. That's up from around 100 million ounces just 5 years earlier. The trajectory is still pointing up. Then there's electric vehicles. A typical internal combustion car uses about half an ounce of silver. An electric vehicle uses closer to 1 to 2 ounces because of the additional electronics, battery management systems, and charging components. EV production is growing globally despite some slowdowns in specific markets. Every EV that rolls off an assembly line adds to silver demand. Then there's the sector that nobody was talking about 3 years ago, AI infrastructure. Data centers are expanding at a pace that's hard to comprehend. The compute power required to train and run large language models requires massive server farms. Those servers need silver for thermal management, electrical connections, and component manufacturing. Some analysts estimate that AI-related silver demand could add another 50 to 100 million ounces annually by 2027. That's a new demand category that barely existed before 2023. So you have solar demand growing, EV demand growing, AI demand growing, electronics demand steady, industrial demand steady, investment demand steady, and mine supply cannot keep up. Here's why. You can't turn on a silver mine overnight. From initial exploration to commercial production takes 7 to 10 years on average. Permitting alone can take 3 to 5 years in most jurisdictions. Environmental reviews, community consultations, infrastructure build-out, all of it takes time. Even if silver prices doubled tomorrow and every mining company on Earth decided to fast-track new projects, the supply response wouldn't show up until 2030 at the earliest. And there's another problem. Most silver production is a byproduct. About 70% of mined silver comes as a secondary output from copper, zinc, and lead mining operations. These mines make their production decisions based on the primary metal, not silver. If copper prices drop and a mine scales back production, silver output drops too, regardless of what silver prices are doing. The supply side is inelastic. It cannot respond quickly to price signals. Meanwhile, demand is being driven by government policies and industrial buildouts that are locked in for years. Countries have committed trillions of dollars to renewable energy and electrification. Those commitments don't disappear because silver prices went up. This is the fundamental picture. Demand growing structurally, supply constrained structurally, inventories draining, and now China restricting exports. The December crash didn't change any of this. The margin hikes didn't add a single ounce of silver to the global supply. They just shook out the leveraged traders. The physical reality hasn't moved. I want to hear from you. If you were holding silver when this crash happened, what did you do? Did you sell at $70 and take the loss? Did you hold through the volatility? Did you buy more when the price dropped? Drop a comment below and tell me your experience. I read every comment and I'm genuinely curious how many people stayed calm versus how many got shaken out. Because here's the thing. What separates people who build wealth in volatile markets from people who lose money is not intelligence. It's not insider information. It's emotional control. The ability to watch your portfolio drop 12% in a day and not panic sell. That's a skill. And it's a skill that gets tested in markets like this one. If you sold at the bottom, that's not a failure. That's tuition. You learned something about how these markets work and how you respond under pressure. That lesson will be worth money in the future if you apply it. Now let me show you why this exact pattern has happened before. Because the CME margin hike playbook is not new. And once you see the history, you'll understand why so many people saw this crash coming. What happened in December 2025 was not the first time the CME used margin hikes to crush a silver rally. This playbook has been used before, twice, and both times it worked exactly as intended. Let's start with 1980. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, decided to corner the silver market. They started accumulating silver in the mid-1970s when it was trading around $6 per ounce. They bought futures contracts, physical bullion, and silver mining stocks. By 1979, they controlled an estimated 200 million ounces. As they kept buying, the price kept rising. Silver went from $6 to $11, then $20, then $35. By January 1980, it hit $49.45 per ounce, a 700% increase in just a few years. The exchanges got nervous. The Hunt brothers were taking physical delivery of their contracts, draining the COMEX vaults. There was talk that the exchange might not be able to fulfill delivery obligations. So the COMEX and CBOT took action. They introduced what became known as Silver Rule 7. This rule prohibited the opening of any new long positions in silver futures. You could only trade to liquidate existing positions. At the same time, margin requirements were jacked up dramatically. And the Federal Reserve, under Paul Volcker, was raising interest rates aggressively to fight inflation. The combination was lethal. The Hunt brothers couldn't add to their positions. Their existing positions faced margin calls they couldn't meet. Forced liquidations began. Silver crashed from $49 to $11 in less than 2 months. The Hunt brothers filed for bankruptcy. The day the crash accelerated, March 27, 1980, became known as Silver Thursday. That was round one. Round two came in 2011. Silver had been climbing steadily after the 2008 financial crisis. Investors were piling into precious metals as a hedge against money printing and currency debasement. By April 2011, silver hit $49 per ounce, just below its 1980 high. The CME responded with margin hikes. Not one. 5 margin increases in just 9 days. Each hike forced leveraged traders to post more collateral or get liquidated. Each wave of liquidations pushed the price lower. Each price drop triggered more margin calls. Silver dropped from $49 to $34 in a week. By July 2011, it was trading below $34. By December, it was under $28. The rally was broken. Silver wouldn't see $30 again until 2020. Now look at December 2025. Silver breaks through all-time highs above $80. Momentum is strong. Retail traders and institutions are piling in. Social media is calling for $100. The CME raises margins by 13.6%, then announces a second hike days later. The increases are timed for the holiday week when liquidity is at its lowest. Leveraged positions get liquidated. The price crashes from $84 to $73 in a single session. Same pattern, same tool, same result. Critics have been asking the same question for 45 years. Are these margin hikes designed to protect market integrity? Or are they designed to protect the banks and institutions that hold massive short positions? We don't have internal CME documents proving intent, but we have pattern recognition. Every time silver threatens to break out in a way that could cause catastrophic losses for short sellers, margin requirements spike and the rally gets crushed. In 1980, the shorts were protected. In 2011, the shorts were protected. In 2025, the shorts were protected. You can call that coincidence, or you can call it a pattern. But here's where 2025 is different from 1980 and 2011. In 1980, the rally was driven by two wealthy brothers trying to corner the market. When they ran out of capital, the demand disappeared. In 2011, the rally was driven by post-crisis speculation and inflation fears. When sentiment shifted, the buyers evaporated. In 2025, the rally is driven by structural industrial demand that doesn't disappear when the price drops. Solar manufacturers still need silver for panels. EV makers still need silver for components. Electronics companies still need silver for circuits. AI data centers still need silver for servers. These buyers don't care about momentum or technical analysis or what's happening on social media. They have production schedules to meet. If silver drops 12% in a day, they buy more because they're getting a discount on something they were going to buy anyway. This is the fundamental difference. The margin hikes can flush out speculators, or they cannot flush out industrial demand, and they cannot add a single ounce to the supply side. The pattern says the CME can break rallies. The fundamentals say this rally is built on something the previous two were not. That tension is what makes the next few months so interesting. So where does silver go from here? Let me lay out three scenarios based on what we know right now. Scenario 1, the bullish case. Silver consolidates between $75 and $85 for the next few weeks. The leveraged positions that got flushed out in December don't come back immediately. Volatility calms down, the market builds a base. Then in late January or February, buyers return. Industrial demand remains steady. Investment demand picks up as the Federal Reserve signals rate cuts later in 2026. China, as export restrictions start showing up in physical availability. Premiums widen. Inventories keep draining. Silver breaks above $84 and doesn't look back. It tests $90, then $100. By mid-2026, it's trading in triple digits. This is the scenario Bank of America outlined in their recent forecast. Their analysts published a target range of $135 to $309 per ounce. That upper number sounds extreme until you remember that silver gained 150% in 2025 alone. Another 100% move from current levels would put it around $160. Bank of America's thesis rests on three factors: continued supply deficits, accelerating industrial demand from solar and AI, and monetary policy shifting back toward rate cuts, which historically supports precious metals. The $309 figure represents their high-end estimate if multiple bullish catalysts hit simultaneously. A supply shock from China, a surge in investment demand, and a weaker dollar environment. Probability of this scenario playing out fully? Maybe 30%. But even a partial move toward these targets represents significant upside from current levels. Scenario 2, the neutral case. Silver chops around in a wide range for most of 2026, call it $65 to $90. The December crash spooked enough traders that speculative interest fades. Volumes decline. The market becomes range-bound and frustrating for anyone looking for clear direction. Industrial demand stays strong, which puts a floor under prices. But investment demand weakens as other assets compete for attention. Crypto rallies, stocks rally, money flows elsewhere. China's export restrictions create periodic supply scares and price spikes, but the market adjusts. Alternative supply sources develop, recycling increases, the shortage remains, but doesn't accelerate. In this scenario, silver ends 2026 somewhere between $70 and $90, still elevated compared to 2024 levels, but not the moonshot that bulls are hoping for. Probability, maybe 40%. This is the boring outcome that doesn't make headlines, but is entirely plausible given how markets often consolidate after massive moves. Scenario 3, the black swan case, something breaks. A major bullion bank fails to deliver on physical silver contracts. A large, short position blows up and triggers forced buying instead of forced selling. China escalates export restrictions to a full embargo. A geopolitical crisis disrupts mining operations in Mexico or Peru. Any of these events could trigger a supply panic that the paper market cannot contain. In this scenario, the futures price decouples from physical reality. COMEX prices show one number, but actual silver trades at a massive premium because there isn't enough metal to go around. Industrial users start hoarding inventory. Investment demand explodes as people realize the shortage is real. This is how you get $200 silver or higher. Robert Kiyosaki, the author who wrote Rich Dad, Poor Dad, has been publicly predicting silver at $200 by the end of 2026. His thesis centers on systemic financial instability and a loss of faith in paper assets. Is he right? Maybe. The conditions for a supply panic exist. The structural deficit is real. The inventory drawdowns are documented. The Chinese restrictions are tightening. But black swan events are by definition unpredictable. You can't time them, you can only position for them. Probability of a full-blown supply crisis in 2026, maybe 15 to 20%, low but not zero. And if it happens, the move will be violent. The asymmetry here is what matters. In the neutral case, silver goes sideways and you make modest returns or break even. In the bullish case, silver doubles and you make significant profits. In the black swan case, silver triples or more and the gains are generational. The downside is that silver drops back to $50 or $60 if industrial demand weakens or if a recession crushes commodity prices across the board. That's a real risk. It should be part of your calculation. But the upside scenarios have more room to run than the downside scenarios in my view. The fundamentals support higher prices. The supply constraints are real. The demand drivers are locked in by policy. The question is whether you can hold through the volatility to get there. If you're holding silver or thinking about buying, there are 4 indicators I'm tracking right now. First, the gold to silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, the ratio sits around 57 to 1. Historically, when silver is in a bull market, this ratio compresses. It drops to 40 to 1, sometimes 30 to 1. If you see this ratio falling in the coming weeks, it means silver is outperforming gold. That's a signal that industrial demand is overwhelming the market. Second, Shanghai premiums. Watch the price gap between physical silver in Shanghai versus paper silver on COMEX. Right now that premium is running $8 or higher. If it widens, it means Chinese buyers are bidding up physical metal faster than the paper market can keep up. That's a sign the futures market is losing its grip on price discovery. If the premium narrows, it suggests the export restrictions aren't biting as hard as expected. Third, mining stocks. Silver miners have been underperforming the metal itself throughout this rally. That's unusual. Normally, miners offer leverage to the commodity price. When silver goes up 10%, miners should go up 20% or more. If mining stocks start catching up to the metal, it signals that institutional money believes the rally is sustainable. Smart money tends to buy miners when they expect higher prices ahead. Fourth, Fed policy signals. Markets are currently pricing in multiple rate cuts for 2026. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. If the Fed confirms this trajectory, it provides a tailwind for precious metals. If inflation spikes and the Fed reverses course toward hikes, silver will face headwinds. These 4 indicators won't tell you exactly where silver is going, but they'll give you early warning signs of which scenario is unfolding. The December crash taught a brutal lesson about the difference between trading silver and owning silver. If you were holding silver futures with 10 to 1 leverage when the margin hike hit, you probably got liquidated. Your position was closed automatically at the worst possible price. You had no say in the matter. If you were holding physical silver bars in a safe, nothing happened. The spot price dropped on your screen. Your metal stayed exactly where it was. Nobody could margin call you. Nobody could force you to sell. This is the distinction that veterans in this market have been making for decades. Paper silver and physical silver are not the same thing. Paper silver includes futures contracts, ETFs, and other financial instruments that track the price. You don't own metal. You own a claim, a contract, a share in a fund. That claim is subject to exchange rules, counterparty risk, and forced liquidation. Physical silver means bars, coins, and rounds that you hold directly or store in an allocated vault. No leverage, no margin calls, no counterparty. The old saying in precious metals circles is simple. If you don't hold it, you don't own it. That sounds paranoid until you watch a margin hike wipe out thousands of traders in a single session while physical holders sit untouched. Does this mean you should never trade paper silver? No. Futures and ETFs have their place. They offer liquidity and convenience. They let you gain exposure without dealing with storage and insurance. But you need to understand what you're holding. If you're trading futures with leverage, you're speculating. You're making a short-term bet that can be wiped out by exchange decisions you don't control. Size your positions accordingly. If you're holding physical metal, you're investing. You're accumulating an asset that has held value for thousands of years. You can ride out volatility because nobody can force your hand. The crash separated these two groups cleanly. Speculators got flushed. Holders stayed put. Decide which group you want to be in before the next margin hike hits. If you own silver right now, here are 5 things you need to do. 1. Audit your leverage. If you're holding futures or trading on margin, calculate your actual exposure. How much would you lose if silver dropped another 15% tomorrow? Could you survive a margin call? If the answer makes you uncomfortable, reduce your position size. The volatility in this market is not finished. 2. Define your exit plan. Don't wait for a crash to figure out when you'll sell. Decide now. Pick a price target where you'll take partial profits. Pick a stop level where you'll cut losses if your thesis breaks. Write it down. When prices are swinging 10% in a day, you need a plan you made with a clear head. 3. Watch the $70 level. This is the floor that held during the December crash. If silver tests $70 again and holds, that's confirmation of strong support. If it breaks below $70 with volume, the next support zone is $60 to $65. Adjust your expectations accordingly. 4. Separate your trading stack from your holding stack. If you want to trade the volatility, use a small portion of your total silver exposure. Accept that you might lose it. Keep the rest in physical metal or long-term positions that you want touch regardless of short-term price moves. This separation protects you from making emotional decisions with your entire position. 5. Ignore the noise. Social media will tell you silver is going to $200 tomorrow. Social media will tell you silver is crashing to $30. Neither extreme is likely in the short term. The fundamentals point to higher prices over the medium term, but the path will be volatile. Turn off notifications. Stop checking the price every hour. Make your plan and stick to it. The people who build wealth in markets like this are not the ones who predict every move. They're the ones who manage risk and stay in the game long enough for the thesis to play out. The crash from $84 to $73 was brutal. It wiped out over-leveraged traders. It shook confidence. It made a lot of people question whether this rally was real. But it didn't change anything that matters. The supply deficit is still there. Industrial demand is still growing. China's export restrictions are still in effect. The inventory drawdowns are still happening. The margin hike flushed out the weak hands. It didn't add a single ounce of silver to the global supply. It didn't reduce demand from solar manufacturers or EV makers or electronics companies. It didn't reverse the structural shortage that's been building for 5 years. What it did was reset the market. It cleared out the leverage. It transferred silver from traders who couldn't hold to buyers who were waiting for exactly this opportunity. If you sold at $73, you paid tuition. The lesson cost you money, but now you understand how this game works. The exchanges can change the rules. The algorithms can trigger cascades. And if you're overexposed when it happens, you're out. If you held through the crash, you proved something to yourself. You can handle volatility. That skill will matter more than any single trade. If you're still on the sidelines trying to decide what to do, understand what you're looking at. This is a market with shrinking supply, growing demand, and a 45-year technical breakout that just got tested and held. The crash was the shakeout. What comes next is the opportunity. Whether silver hits $100, $150, or $300 in the next few years depends on factors none of us can fully predict. But the setup is as strong as it's been in decades. Stay rational. Manage your risk. And if you believe in the thesis, don't let a margin hike scare you out of your position. If this breakdown helped you understand what happened and what's coming next, subscribe to the channel. I'm tracking this market every week, and you don't want to miss what happens from here. Drop a comment below and tell me your silver price target for 2026. Are we going back to $84 and beyond, or do you think we see $50 first? Let me know. I'll see you in the next one.